Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I'm sure you'd have guessed from the title that today's video is about penny stocks. Now, penny stocks is a dangerous name to utter given the kind of environment that we are in. However, I am of the view that if sensible investing principles are followed and if a long-term approach of at least 2 to 3 years is taken, then one can invest in penny stocks even in the current environment and end up making good money over a 2 to 3 year period. Therefore, sensible investing is the key. You can't throw all the caution to the winds and be reckless in your penny stock investments. That way surely lies sorrow. So here's the list of 10 penny stocks that my penny stock system has identified for investment in the current environment. In other words, if I were to start building a penny stock portfolio, it would have a lot of the names from this list or at least have fundamentals similar to the stocks on the list. Now, what is my definition of a penny stock? My definition of a penny stock is a stock that is trading in the stock market at a price of rupees 100 or lower. Effectively, a stock which trades in the stock market at a double-digit stock price. A lot of people have different definitions for penny stocks. For some people, penny stocks mean stocks which are trading in the stock market at rupees 10 or below, at rupees 50 or below. But according to me, if you consider that particular benchmark of 10 rupees or 50 rupees, there are not many good quality penny stocks that are available in that range. So to have a large enough pool of stocks, a large enough pool of good quality stocks, my definition of penny stock is a stock that's available in the stock market or that's trading on the bosses at a price of rupees 100 or below. Now, before I go further, the standard disclaimer. This should not be construed as a recommendation from my side. You are advised to take the help of your investment advisor before investing in these penny stocks. Now, moving on to the most important question. Why these penny stocks and not others? What makes this group of penny stocks so special? Well, here's your answer. You see, I'm a big fan of billionaire investor Howard Marks. He is amongst my favorite investors and right up there alongside Buffett, Munger and a few others. In a recent interview, Marx said something interesting that made me think really hard. Marx was talking about the possible sources of superior performance in the stock market. You see, all of us invest in the stock market with the intention of putting up a superior performance, that is, outperform both the stock market index as well as our fellow investors. Now, the game of investing is such that not all of us can end up with a superior performance. Most of us will either end up earning market-like returns or even below market rate of returns. And it is only a small minority of investors that will be able to put up a market-beating or a superior performance consistently over a long-term period. So, majority of the investors will either have below par or market-like returns, and only a small group of investors will achieve superior performance. Now, what could possibly be the secret sauce of superior investors? What kind of advantages do they possess that allows them to outperform the rest of the investors in a big way? Well, Howard Marks was of the view that all superior performance boils down to two things. Number one, superior investors have a better comprehension of the future. They are able to judge the future better than the others, and this gives them an enormous advantage. I think this makes a lot of sense, doesn't it? Everyone has access to the information and data about the past and the present. And therefore, if you try to put up a superior performance using this data, it may not work. However, there is no data available about the future. You have to come up with your own scenarios and use your own judgment to draw up a picture of the future. And the more accurate your judgment about the future, the better your performance. Let me explain this with an example. You see, back in the 1970s, 80s, a soft drink brand had taken the world by storm. And while other investors were focused on the company's supply chain or its brilliant marketing or its outlook 2 to 3 years down the line, Warren Buffett had a totally different take on the company's main product, which is of course a bottle of the soft drink. He realized that it had no taste memory. You can drink one of these at 9 a.m., 11 a.m., 2 p.m. in the afternoon, 5 p.m. in the evening. You cannot do the same with beer or orange or grape. You get sick of them after a while. But there was no taste memory to this soft drink. The average person drinks about 2 liters of water per day, and you can have all 2 liters of that be this soft drink. Now, if you do that with almost anything else, with just one product, you will get sick of it, and that's a huge factor. So Buffett and Munger analyzed this soft drink stock from a completely different perspective and had a much longer term horizon than most other investors. This insight that this soft drink has no taste memory came to Buffett and his partner Munger after a lot of hard work and reading, and it is a perfect example of how they comprehended the future better than most other investors. I'm sure you'd have guessed by now that the soft drink I'm referring to is Coke, and the company is none other than Coca-Cola, one of Buffett's biggest and most successful investments. I think very few professional investors other than Buffett and Munger analyzed Coke this way. This advantage of comprehending its future better than most others allowed them to invest in Coke and earn those superior market-beating returns over the long term. I think this is a great case study in how the ability to predict the future better than others can be such a powerful source of superior performance. However, acquiring this ability is not easy at all. It requires tremendous hard work and a lot of reading and researching. In fact, Buffett himself argues that in order to be a superior investor, one has to read a minimum of 500 pages per day. Only then one can be a better investor than most others. Now, I'm sure that this is an exaggeration, but reading even 300 or for that matter 200 pages is not easy. If you are able to do that, good luck to you. I think you are on your way to becoming a superior investor if you follow other sensible investing principles along with it. But if you are not the kind, then there is some hope for you in the form of Howard Marks's source number 2 of superior performance. According to Marks, the second source of superior performance is the superior ability to process qualitative information. Please remember, quantitative information is easy. Everyone has it, and therefore it cannot be the source of superior performance. However, qualitative information like the quality of management, the culture of the company, the quality of its products, its R&D, etc. These are things that are hard to quantify, and therefore an investor who is able to process this qualitative information better than others certainly has an edge in investing. Now, in addition to these qualitative information, there is one more source of qualitative information. It is my personal favorite, and I have used it with a good degree of success over the years. This qualitative information is all about trying to understand the collective psyche or the group mindset, if you will. In particular, I look for penny stocks where the sentiments are so depressed that it has pushed the price of the stock to well below its book value, or the stock is trading at single-digit price to earnings multiple, popularly known as the PE ratio. I look at the stock's 5 to 10 year earnings history, and I look at its balance sheet, and I try to figure out whether the price is likely to stay depressed or can go up again once the economic situation improves. I know I can go wrong with respect to any 1 or 2 penny stocks here, and therefore I try to diversify my risk. I like to recommend a bunch of these, that is at least 15 to 20 stocks. This ensures that even if a few continue to trade at depressed prices, the gains in the other stocks more than make up for it. And so far, they have certainly been able to do this job really well. You see, I have closed 35 recommendations in my penny stock service that I run for Equitymaster. And out of these 35, only 6 have been closed in the negative. The remaining 29 have all been closed in the positive. The average gain has been 82% with an average holding period of 10 months. So in conclusion, there are 2 ways of trying to put up a superior performance. You see, I am not interested in buying the next Coca-Cola or the next Amazon or Google or what have you. I can't read 300 to 400 pages per day and then once I zero in on a stock, buy and hold it for decades. I just don't have the temperament to do that. which is why I chose the other option of putting up a superior performance. This option is all about trying to find penny stocks that are trading at depressed valuations, that is below book value or low PE ratio, and buy at least 15 to 20 of these. If their fundamentals are decent and if they have strong balance sheets, there's a strong chance that as a group they may end up doing well over a 2 to 3 year period. If my experience is any indication, it has certainly worked out quite well. Now I'm sure you're wondering, if this is so easy, why other investors don't follow this approach? Well, most investors try to follow what's popular and don't really look at depressed stocks. They think that stocks that are depressed will always stay depressed and hence don't buy them. But as my experience shows, this is certainly not the case. Of course, out of a list of 15 to 20 stocks, few stocks may remain depressed. But if a stock has a good earnings history and has a strong balance sheet, it usually recovers over the next 1 to 2 years and ends up giving good returns. Let us say that most people don't have the stomach to be contrarian, and this is how we can take advantage of them. So here's the list once again. These are penny stocks that I would strongly consider investing in right now if I were to put together a penny stock portfolio. Mind you, these are not actual recommendations. If you want to invest in these names, it's better that you talk to your investment advisor first. Okay, so that was all from my side today. If you found the session useful, please do not forget to give a like to this video. You can also leave a comment in the comments box. I'll see you again next time. Goodbye and take care.